Welcome to the show today. Europe, small cap investing, Trump, US markets, nuclear war, gold, and Bitcoin. I'm catching up today with Mike Taylor, CEO and founder of Pi Funds. This episode is critical, in my view, to tie a bow in 2024 and to enter 2025 with confidence. If you would like to reach out to get a full review of your financial circumstances, please reach out. Link in the show notes. If you like today's episode, make sure that you like and subscribe. Leave a comment or a question or a concern in the comments below. Let's get started. So welcome everybody to the Everyday Investor Podcast. Today I'm catching up again with Mike Taylor from Pi Funds. How are you, Mike?
I'm good. Thank you.
Awesome. Okay, so I want to go through a little bit of 2024 in the hope that we can get a clue as to what we might see in 2025. So starting with the US, and before we get on to why maybe Donald Trump is good for investor sentiment, like why is that actually true?
Yeah.
Were you surprised that Donald Trump got in?
Well, I want to preface kind of our comments about Trump just to say that I'm, politically agnostic in my comments here, and as an investor, all I can do is play the hand that I'm dealt. Typically, Republican presidencies are seen as more favorable for equities, and often they do preside over periods of strong market performance. So there is an anticipation building that this particular 4-year term for the Republicans will be very favorable for stocks. Now, there's a couple of reasons for that. This is Trump's second time around. He had a go 2016 to 2020. The market was up quite a bit over that period. However, a lot of the policies that he wanted to enact didn't end up happening. This time around, he seems to be more determined to follow through, and a lot of the appointees, or the people that he's appointed rather, will be more amenable to some of the people that were in place last time around, and almost more extreme in some of the views that they have. So we can expect from this administration, tariffs obviously is the main one, although I don't necessarily think that tariffs are going to be as negative as people might expect. One reason for that is that there's a lot of bluster out there. I don't really think that Canada is going to have 25% tariffs put on them or to Mexico. Some of those things will end up getting a little bit watered down. The second point would be is that tax rates, corporate tax rates, are expected to come down. How are they going to pay for that? I suppose growth or taking savings out of other areas. Cue Elon Musk and his Doge team. Generally, Trump himself is very pro markets and equities. A strongly performing equity market is bullish for the overall economy. People feel wealthier, they spend more. So he definitely wants to see that happening. They have a positive affiliation, shall we say, with Bitcoin. That's another kind of strong sentiment indicator. So at the moment, it has been anyway. Certainly if Bitcoin's doing well, the market's doing well. So just generally, I think that there's a perception. We will find out in 4 years' time what the reality is, but there's definitely a perception building that this will be a very favorable 4 years for the US market.
Okay. And last time he was in power, so from 2016 to 2020, a little bit of a dip in markets, I think, right when he took office. But then quick rally, off we went. End of the year, 57% up on the Dow. This time around, already sentiment is supercharged. People are kind of anticipating everything that you just said. And I wonder if it will really work the same way this time around. Are investors getting ahead of themselves?
That's a good point. I can see now that sentiment for US equities is at the 2021 peaks, when the stimulus checks are floating around. So everyone is very bullish, and there are certain sectors of the market which are quite frothy, is how I describe it. Do I think that means there's going to be a massive pullback like we saw in 2022? Well, not really with what's in front of us at the moment. We don't have a huge inflation scare. We don't have rates that need to go up from 0 to 5%. So that we don't have anything like that in front of us. We haven't got a supply chain that's trying to fix itself. But there is certainly the possibility that the stock market could go into a 2000 style mania, I think, over the next few years of the Trump administration. I don't think it's anywhere near that at the moment, but I think we've got all the ingredients we need for it to build into that. So that would kind of be my caution for the future, something to watch out for. But yeah, I think a 5 or 10% pullback from here would wash out most of that froth, Darcy.
Okay. So we kind of need like a decent slap in the face, really, to kind of make the base strong to further
Yeah,
build on that, perhaps, right?
yeah, yeah,
But you're certainly kind of predicting a fairly strong bull market. Like I've noticed a couple of posts on social media, you seem to
yeah,
be indicating that that's kind of what your base case is. How are you
yeah.
positioning your portfolios at Pi funds to, I guess, get ready for that?
We've tilted the portfolio to have more of a US skew than we have done in the past. We can talk a bit about Europe and other regions in a moment, but we are more skewed towards the US. And we're pretty fully invested. So one of my kind of, I guess, hallmarks over the last 17 years is to carry a lot of cash within the funds, and as I said earlier, to be quite conservative. At the moment, it makes sense to be pretty fully invested. The only caveat to that is that, if you are someone who is investing based on mean reversion or that markets can't continue to do well forever, you're fully invested at the bottom and you're cashing out on the way up. The problem is you can't really determine those with a great deal of accuracy.
Mm.
So in a market like we're in at the moment, continue to, I suppose, go with the flow until you feel that the risks are make it too dangerous to stay in the market. I don't think we're there at the moment.
Okay.
So it kind of makes sense to be fully invested, always with an eye on the exit. That should be the case anyway,
Yeah.
regardless of the situation.
Okay. Like the one thing that I have been watching, I won't just say out of the corner of my eye, I do look at it every now and then, is the drums of war, which have
Yeah,
certainly, like, where are we? We're at the 11th of December at the time of recording, just for a bit of a timestamp there. And it certainly feels like with what's developing in Syria, and if you ignore what the leaders are saying and actually what they're doing, I know that markets largely price in all known information to a certain extent, but it's probably how accurate they're pricing in the risks associated with war that I wonder about. And I just wonder if there is a point where things escalate to a point where the market hasn't actually anticipated that outcome. Is that something that features in your, I guess, imagination when you're thinking about the future and what it will be like investing in 2025? Are you concerned about maybe whether it's exacerbated by Trump or not, putting that aside, are
yeah,
you concerned
yeah.
about war in 2025 extending?
Well, I think what we've picked up over the last couple of years is that from an investor perspective, we've probably given too much weight to the tail risk associated with wars that we've seen in Russia, Ukraine, and Israel, Iran, or in the Middle East. In that markets aren't actually concerned about war, particularly when it doesn't really impact, the economic powerhouses of the world, be that China, US, and Europe. So, of course, European markets were impacted in 2022 from an increase in gas prices, but I think they would have fallen anyway without the war, just because of the impact of rising interest rates. So, there's one real risk that's attached to wars, obviously, absence aside, and nuclear weapons, use of nuclear weapons, is the price of oil. So you only really need to worry about the price of oil from an investment perspective. What does that mean at the moment? You probably don't need to be concerned unless oil goes over $100 a barrel.
Okay. We're far away from
So
that at the moment anyway, right?
we're far away from that. In fact, the oil market is oversupplied at present. So
Mm.
you would have to have, like the Straits of Hormuz blocked or something like that, where you're taking out 5 million barrels a day to see oil go over 100.
Mm.
So yeah, I mean that's really the major concern. We're very fortunate where we live in the world, uh, you know.
Mm.
So we definitely won the lottery from that perspective. So as I said, absence the use of nuclear weapons, which are a black swan event, we can't run our portfolios on the basis that that might happen. In fact, there really is the potential for those wars to de-escalate in 2025. Trump seems to be very focused on Ukraine, getting them over the line to some sort of armistice
Yeah.
in the next 12, you know, 3 to 12 months. Then in the Middle East, I think if you look at Syria potentially in the same way as what happened in Libya with the overthrowing of Gaddafi, there
Mm,
is a potential for that power vacuum post and a lot
mm,
of infighting between different factions to sort of assume control of the country. I
yeah,
would predict that Syria will have a similar, given there are so many different groups with different interests over parts of that war torn country. It will
mm,
be quite challenging for someone to diplomatically, democratically, should I say, take control and run the government. But
mm,
who knows? I think they're probably past the point of wanting another oppressive regime. That's pretty clear.
mm.
The groups supporting those different regimes, Hezbollah and Hamas, have been significantly weakened, as has Iran. So I'd say it's more likely that things will de-escalate through there than go the other way.
Okay, that's interesting because yeah, like I can kind of see through that. It feels like the messaging pre-election with most mainstream media sources was that Donald Trump was going to be bad for peace, like he would exacerbate
Yeah,
things, cause more war. It
yeah,
seems like the opposite is happening before he takes office, and I kind of am starting to come around to that idea that maybe we have over accounted for escalation and underpriced or underestimated the possibility of de-escalation. And it's not like it's going to be world peace forever, but certainly there could be a few years of peace before
yeah,
things change. And I guess with the oil thing as well, like that doesn't necessarily affect the whole world the same way. Like it wouldn't affect the U.S. market the same way as say Europe
yeah,
or Asia,
yeah.
right?
hmm What I've picked up from listening to Trump and also his other family members that speak about things, I was listening to Eric Trump yesterday, is that they are very anti-war. They want to channel all their energy essentially towards business, and so any money that the U.S. government is having to spend defending, sort of proxy wars elsewhere, they don't want to be involved in that. They want to redirect that back home,
Mm,
whilst at the same time maintaining a strong military presence, so they can, still be that world policeman slash bully. So I think that would be their policy. Their foreign military policy was,
yeah,
we're here, we're strong. If you do something wrong,
yeah,
we will hit you hard, but we're not going to, we want to try and pull everything back from these foreign wars that we've been involved in.
certainly hope so. Okay, and
Yeah.
so and then going back to that tariff talk just a little bit more,
Yeah.
like to me it kind of feels like well this is probably just classic the art of the deal, right? Where he's
Yeah.
throwing out some pretty significant threats. He's kind
Yep.
of
Yep.
implying in a joking way that he's going to annex Canada, and the
Yeah.
governor,
Yeah.
Justin Trudeau, will be invited
hmm
to Mar-a-Lago again. But as it relates to New Zealand in particularly, and also our trading partners, how will the tariff stuff, if it actually does eventuate, how do you see that playing out here in New Zealand? Like, will it affect us dramatically? Like, I'm talking economically, but also from a market point of view.
I don't think so. I mean, not a big proportion of our exports actually go to the US. I can imagine there'd be quite a few things that would be excluded. I guess if we're exporting meat and dairy, given that they are, staples, I would be surprised if they are not excluded from tariffs. Possibly wine might have might have a tariff put on them. But again, given our relationship with them, that we may end up being excluded.
Hmm.
And if there is a tariff, it'll probably only be 10%. So I consider it to be quite
Sure.
minor.
Right, just a tithe. Well, okay.
Yeah.
I'm kind of jumping all over the show here, and I'm just going
Yeah.
back to the threat of nuclear war now again. Obviously,
Yeah.
it's not a very
Yeah.
nice thing to think about this. It's pretty scary, but considering New Zealand, right? Our our exports, primary industries, a lot of the raw
Yeah.
materials. How valuable would things like milk and wine and meat be when it comes from the corner of the southern hemisphere, far, far away from any nuclear fallout? Like, wouldn't that be amazing? Well, not in a good way. We don't want that, but in terms
Yeah,
of
yeah, yeah, sure. I
silver
guess, I
lining,
mean, yeah, a lot of crop production and the like would be wiped out. I'm not depends where that nuclear weapon is dropped. If it was going to be dropped anywhere, I suppose it's in Eastern Europe, and of course, we know that a lot of the crop production from Ukraine has been taken out of the market anyway. But
mm,
certainly from that, yeah, as you say, the fallout if it went into Western Europe would be significant.
yeah, okay. And like when we look at the performance of markets in 2024, how can you kind of sum up the year in 2024 from a European perspective in particular?
Well, Europe hasn't been a very good place to invest, not just last year, but over the last. In fact, I think the US has outperformed. Maybe it's I forget the stat. It might be 11 years in a row, but it's a significant period of time. And the world's biggest companies are essentially US. There's a small selection of companies in Europe, like Novo Nordisk or Louis Vuitton, which are their big companies. But by and large, below that, everything's a lot smaller. Europe, it's not the United States of Europe. So there is a problem, and you've got all these different countries doing different things and operating not necessarily in unison as they're supposed to. We had the UK pull out, which was quite disruptive for the union as well, and not good for the UK as it's turned out. There's been political chaos. The French index, the CAC 40, is down about 2% year to date. FTSE's up about 7. DAX, interestingly enough, even though Germany's in recession, has performed the best within the region. Still trying to drill down into why that is. I can't give you an answer other than the interest rates have fallen quite a bit in Germany. Their sort of bond yields are around mid twos, so that's quite low if you compare it to other regions. But there is a sort of a bright spot where we've tended to focus in Europe. As you know, we've got an office in London, Scandinavia. Particularly, we find a lot of ideas coming out of Sweden.
Hmm.
They spend more on R&D in those particular countries. They are of similar size to New Zealand, and they do have quite a few, household names that you can think of
IKEA.
in
Yeah.
terms of the region. Yeah, yeah, IKEA, Novo Nordisk, which is Denmark. You've in the past you've had the mobile phone companies up through there as well, and not to mention Norway is one of the richest countries in the world because of their sovereign wealth fund
Yeah.
and the gains from oil and gas. So that's kind of a region where we skew to. The rest
Hmm.
of Europe through the middle, which would have been the powerhouses, Germany and France, have been challenging. Ironically, the European pigs, as they were called in 2011, Portugal, Ireland, Italy, Greece, and Spain, have actually done okay. They've recovered faster since COVID. And I think that's on the back of tourism. So those countries in particular have performed well. We've seen this revenge travel post COVID. If you go to have a holiday in Mallorca, we know this because we invest in the airport that's there. They've got record tourism numbers. Like 34 million people go to Mallorca a year as tourists.
Wow.
And so obviously Greece as well has done particularly well with tourism. You can't just say, oh, Europe. You have to be quite specialized in where you're going to put that money.
Got it. Because the outperformance of some countries could be soaked
Yeah,
up by the underperformance of the other ones. It's like the
yeah,
worst kind of diversification you'd want to engage in. So,
yeah,
and
yeah.
presumably it's like based on what you were just saying before, it sounds like it's not too difficult. Well, I shouldn't say
Yes,
that's a relative thing, but it's not too difficult to kind of identify the star performers and then drill down further. But what
yeah.
is the strategy that you guys operate in? Like I know that small caps is seems to be the tool of choice. Is that correct for Europe? Is that what you're trying
Yeah,
to
so
do?
for Europe in particular, we are small cap focused. So we are more bottom up. We're looking for individual companies. And that's why we've ended up kind of going to Spain or to Sweden to find ideas, less ideas coming out of Germany and France at the
Right,
moment.
right,
So rather than, as it turns out, if we'd done top down, we probably would have come to the same conclusion.
yeah,
But yeah,
okay. I want to ask you just a little bit more of a question around small cap investing
yeah,
in terms of general knowledge to help audience out understand
mhm,
the benefit of small cap versus mid or large cap.
yeah,
Um, here's a quote from. I'm just gonna make sure I can see this. Yeah, here's a quote from Warren Buffett. If I
hmm,
was running a $1 million fund today, or $10 million for that matter, I'd be fully invested. It's a huge structural advantage not to have a lot of money. The universe I can't play in has become more attractive than the universe I can play in. I have to look for elephants. It may be that the elephants are not as attractive as the mosquitoes, but that is the universe I must live in. So he's
yeah,
obviously speaking as the guy who's in control of a big pot of money, and he's basically implying that if he had a
yeah,
smaller fund, he'd be able to kind
yeah,
of target
100%. Yeah.
smaller companies. So what's the logic behind small cap investing? What does it actually mean to be investing in small cap? What are the parameters?
Before I answer that, actually, there is a lot of truth in that statement from Buffett. I don't know when he made that comment, but if you look at statistically at the performance of Berkshire Hathaway over the last 40 or 50 years, his outperformance versus bench is continuing to diminish.
Mm,
And so that's just simply a function of the size and the amount of money he's managing. Been particularly lucky with Apple, which was like 30% of the fund at one point before they
right.
did the big sell down.
Mm,
But yeah, it's harder and harder. I would suspect that post his death, it will be almost impossible. He was an enigma. Nobody else will be like him, right?
mm,
Now Charlie's dead as well. I'm sure that the new portfolio managers are great, but with the amount of money that they manage, I think it'll be almost impossible for them to beat the bench.
mm,
So why do we focus on small caps? I think you raised a great point. Is that the less money you have, the easier it is, and then you focus in a market that's most likely to be inefficient. So when you are investing in the biggest names in the world, you have the best, the brightest, the smartest, the most amount of money chasing alpha or performance there. So it's sort of like every time you want to go and do something, you're competing against Olympic gold medalists every day, all day. Whereas if you invest in smaller companies, typically, uh, so you're not going to get quant funds in there because it's too small, it's illiquid.
mm,
So all that performance that's generated or arbitraged out of bigger markets because someone's looking at momentum factors or earnings factors is not used in small cap space. Small cap space consists of um, managers like me and retail investors.
mm,
And retail investors typically underperform markets, buy the high and sell at the low. On average, most small cap managers are actually able to beat bench over a period of time, whereas
mm,
it's the flip side for large cap managers. Even passive underperforms because there is a fee drag.
mm.
So you've got the big boys aren't there, and then you've got these businesses, some of whom go on to become unicorns or even bigger. Every company that is an Apple once started as a business in the garage, right? So
That's right. Yeah.
uh,
Yeah.
plenty of businesses that are started small become big, and that's where you can make a lot of money by
Yeah.
finding companies that start at listed at $100 million and become $100 billion.
Got it. And obviously, like a $1 improvement on a share price on something that's already $100. Well, that's 1%, but a $1
Yeah,
improvement, a $1 share price, hey, that's pretty good. But I know
yeah,
it's a bit complicated than that. But I guess when you have a bull market,
yeah,
then you have, I don't know if trickle down is the best word to use here, but I'm guessing
yeah.
you have a lot of spillover effect where people might be cashing out, taking profits, and then rotating into smaller caps. Is that kind of the pattern that you would expect to follow
Yeah,
if you
there's
saw?
typically two periods of a market cycle where small caps will do well. The start of a bull market, so small caps will get decimated in market sell-offs for a number of reasons. But
Yeah.
when a market bottoms, because small caps have fallen the most, they tend to rally the most in the initial phase of the bull market.
Okay.
You've got interest rates coming down, you've got sentiment changing, so they'll pick up. And then the other part of the market phase, I guess, is towards the latter end of the market when there is euphoria and sort of mania, as I've alluded to earlier, where people are just chasing anything, and you can get small cap names performing very well at that and during that phase.
Okay. Interesting. Okay. All
But
right.
we're obviously not
So,
at the beginning. We're
right.
past that now.
We're somewhere in between
But
those two phases, right?
yeah, but I mean, small caps have got a lot going for them relative to the larger counterparts from a valuation perspective. The S&P forward multiple now is high. We're looking at 22, 23 times
Yeah.
multiple. The Russell is sort of high teens, and European small caps are about 12 times.
Mm.
You've got some valuation support there, which you don't have buying big tech.
And I'm just thinking about this from a business owner myself and just
Yeah.
imagining if I had a much, much bigger business from my perspective, but still a small cap considered from a market perspective, I would assume that given the cost structure of large companies, that those costs would be hard to reduce during downtimes, and therefore there's probably a bit of a lag as they soak up the slack when the market turns again. Whereas a smaller company would have probably stripped out a lot of that cost, so that if the market does improve, particularly in the retail space where sentiment is so critical,
Yeah,
they would
yeah,
probably capture that revenue faster. Would that be fair enough?
yeah. I think that's a reasonable assessment. As coming out of a recession, a smaller company has cut costs because they had to survive, so they'll experience a big jump in operating margin quite quickly.
Yes.
Yeah.
Yes. Okay. All right. Let's now change lanes here a little bit and talk
Okay.
about. I want to talk about two items in my own portfolio for the last 7 odd years, and
Yeah.
two items that have been really topical for 2024: gold and Bitcoin. Let's start with
Yeah.
gold. I believe I read somewhere recently that the performance of the S&P 500 index almost identical to that of gold in 2024, and
Yeah.
we were just under $2,000 an ounce US dollars this time last
Hmm.
year. We're at
Yeah.
around 2,700 today. What do you think were the fundamental drivers of price for 2024 as it relates to gold?
So there was increased central bank buying. The Chinese central bank was quite a big buyer for the first part of the year. They paused for a while. They just actually started buying again in the last week, which is why gold's, I think, started to move higher again. I mean, inflation has come back down, but inflation has been running higher than previously. And so, whilst we see inflation at 2 or 3% now, there was a bit of a catch up for the gold price to do to kind of keep up with what inflation has done in the last 4 or 5 years. As you mentioned, we discussed earlier the geopolitical risks. So there's been probably a decent amount of retail buying in gold because of the safe haven that it would provide from that. The third point would be is that we've got the US and other big countries running large deficits. At 7%, I think, is the US deficit, and that's not sustainable. So people are looking at things as an alternative to the dollar, as a place to store capital. And so I think that's another reason why gold has gone up, because heaven forbid if something was to happen to the dollar, then where are you going to park your money? So
Mm,
therefore, I think gold has done well for those 3 points. I know you had sort of asked me to talk a little bit about technicals.
yeah, that's right.
From a technical perspective, gold has been setting up for this bull move for over a decade. So, from a technical perspective, since 2011 until the early 2020s, it had formed what we call a cup. So, a cup with a handle, it's pretty easy to visualize that. And typically, when you form a cup with a handle and you get a breakout from the handle, then you can rally the size or the depth of the cup, which
Right.
sort of takes gold to somewhere between 2,800 and 3,000.
Mm,
And we are, as at today, over 2,700. So getting close to that target range from the breakout.
right. And do you see it going further based on the fundamental drivers? That's like specifically the central bank buying of gold. I find that very, very interesting. But do you feel like the that price target of 2,700, 2,800, maybe a little bit higher, do you think that that kind of will be adjusted again, or am I just getting a little bit too bullish and too carried away there?
Well, we need to see what happens with those dynamics. If the Chinese stop buying for a while or for longer, then you're taking away a big source of the demand. I think that central banks have recognized that holding US treasuries as their form of security is not necessarily a great thing to be completely focused in one area for your deposits, and so they're diversifying away. Whether strategic reserves move into Bitcoin as well, but certainly for the moment, strategic reserves are in gold. We
Hmm.
do know that Fort Knox, right, is where the US keeps their strategic reserve. I think gold has proven itself since the dawn of time to be able to keep pace with inflation, and people are possibly finally cottoning on to that more so than they have in the past. Inflation was dead from what for 20 years, and then suddenly it's reared its head,
Hmm.
and I think that's brought this to light again as to gold's place in the portfolio.
What do you think the odds are of some sort of currency event situation? And the reason why I'm asking that is just because it's central banks in
Yeah.
certain countries that are really stockpiling gold right now, which oddly happened after there's a lot more talk around BRICS, U.S. strategic Bitcoin reserve being talked about right now, which would require a revaluation of gold. There's all these things going on, but to me, it kind of feels a very Bretton Woods esque, and
Yeah.
that's over 70 years ago, I guess now. But do you think that there is a risk, like a non-zero possibility, that we could see some form of currency reset with the U.S. dollar?
Well, I think what people have realized is that whether it's with gold or with Bitcoin, is that the supply of that is limited. Whereas the US government can just print whatever money that they want year after year. And that's going to continue to devalue the US dollar.
Yeah,
And so, relative to other assets, not necessarily to the New Zealand dollar or to the euro, it's to other assets. And so, it's your purchasing power. So, if you put your 10,000 US dollars under your mattress, you know that in a decade it's going to be worth less. Whereas if you buy gold um, or property or something else, it's probably going to be worth more. Not guaranteed, but probably will be worth more.
yeah,
Whereas I think you can say with 100% certainty, your US dollar will be worth less.
yeah. That's right.
So yeah, I just think that's people are sort of becoming more sophisticated at not just a central bank level, but at a retail investor level as well. As to that, I mean,
Yeah.
the internet is educating people.
Who knew? There's something really fascinating about that I think what you just said before like makes a lot of sense. People are getting a little bit more switched on to things that were either the realm of those who are like knee deep in it and they don't really talk very
Yeah,
much, like really smart people that are behind closed doors, or at the very
yeah,
least conspiracy theorists, and that
yeah,
seems
yeah,
to
yeah,
be catching on. And regardless of whether it's true or not, it doesn't matter. That's the narrative. And so
yeah.
I just wonder what that means for gold. Do you guys at Pi, do you allocate towards gold? And if so, do you replace the 80 or the 20, the growth or the income when you do allocate?
We're not replacing income. We see gold. We try and get our gold exposure via miners. Obviously, investing quite a bit of money in Australia, there are a lot of gold miners there. So we do hold a number of gold mining companies in Australia.
Yeah.
From a global perspective, we have Newmont as our big position in gold, and which actually hasn't performed that well for us, to be perfectly honest. Sometimes you're better off holding the physical than you are the miners, because miners have a way of increasing their cost base or
Yeah. Well, it's
uh,
kind of like a leveraged play, isn't it? It's like a leveraged strategy because there's no real revenue with mining companies, really, is there? Unless they
yeah,
strike it
yeah.
big.
So small cap miners, gold miners, you can make a lot of money on, particularly with a rising gold price, because if they've got assets which have a high extraction cost, then those assets become much more valuable the higher the price of gold.
Mm,
So you can get a lot of
okay.
price appreciation for small cap miners in that particular case. But yeah, so to answer your question, yes, we have an allocation to gold.
Yeah. Okay. No, that's cool. So let's talk about the digital version of gold now, and we'll
Yep.
slowly start coming in for a landing here. So onto Bitcoin. I know as
Yeah.
probably as recent as 2021, you were one of those
Yeah.
that were quite vocally against Bitcoin. You're a bit of a Bitcoin
Yes.
skeptic. And
Yeah.
as I understand now, you are not. So can you tell me just what happened to change your mind?
Yeah. So my prior thinking was that I didn't think that Bitcoin would be legitimized as an asset class. I thought that it would always stay fringe amongst the kind of community of skeptics, and that it wouldn't get mainstream adoption. Late last year, when it looked like the SEC in the US was going to approve for Bitcoin to be traded in ETFs,
Mm,
I pushed our investment committee very hard and won to have Bitcoin included in our portfolios via an ETF,
yeah.
because I felt at that point, which was earlier this year, that now that it had been made mainstream, that it was an acceptable place to park to park money, or acceptable asset class that people were going to include in their portfolios, where previously it was zero. maybe it would start at 1% and then grow from there.
Mm.
I've become increasingly more favorably disposed or bullish towards Bitcoin as the year has progressed, with more and more people kind of coming along to my view. And now having a US administration that is going to be very focused or very pro Bitcoin, it does seem like there are some strong tailwinds for that asset class moving forward. Much of the same reasons as gold, except that I think that Bitcoin can, in fact, be used more easily as a means of method of exchange. So because it's digital,
Yes.
yeah,
That's awesome, and well done, by the way, for coming around yourself. And then
yeah,
I guess because you could say that, well, you just play the laggard and kind of catch up reluctantly when everyone else did. If you were kind of stuck in the way that, if you forced yourself to double down, like I know a lot of people probably have in 2024, kind of a little bit of hubris kicks in, but you
yeah,
flip
yeah.
real quick. And I think that says something about the active investment strategy that you guys employ. You don't get stuck in your own narratives. You'll flip when you need to, because your objective is to, obviously earn a return for the investors, right?
Yeah, well, if the facts change, I change my mind, basically,
That's awesome.
as they say.
So
Yeah.
and so what is the allocation typically, or is it still kind of fluid and up for debate? Like how much do you guys allocate across the funds?
So at the moment, we are allocating Bitcoin only within our KiwiSaver strategies because our other funds are there as equity funds.
Okay.
So we're not really trying to look at multiple asset classes. Whereas the KiwiSaver product, there is, we've got fixed income, we've got cash, we've got equities and alternatives.
Yes.
In those products. So typical allocation depends on the strategy. It's still relatively small. It's somewhere between 5 and 10% if you're looking at Bitcoin and gold combined.
You'll adjust that as you go, like the rest of, um,
Yeah,
yeah,
I mean, at this point, I would probably be wanting to double my Bitcoin weight, but I have a few other skeptics to convince on that front. In fact, most of the team have told me that I should take profit and it got to 100, just take profit and get out. But
yeah,
the more you understand, you see that supply is constrained, and so long as all the other factors are in play, like US is running a deficit, dollars devaluing, more and more people have to put this in their asset class allocation.
yeah,
Yeah, it feels like a bit. I mean, these are always famous last words, kind of in a bull market, but it does feel like a bit of a one-way street for the moment.
yeah.
What I do think, though, that there is a potential for it to get a little bit out of hand.
But I
Yeah.
guess that's the nature of the
Mm.
beast, and this time it is different in
Yeah.
terms of who the players are, what the forces are.
Yeah.
I think as the market cap grows, personally, my feelings around this is that it does feel like the volatility might subside a little bit as the market cap grows, just because of where it is. But I kind of feel
Well,
like,
it got to in 21. It got to, was it high 60s?
yes, 67, I think it was
Yeah,
63 or 67. I can't remember.
and
Yeah.
that was out without US kind of administration support, without being regulated, and without any kind of mainstream adoption. In fact, it was quite hard for most people to buy a Bitcoin, right?
It
Three
was.
years ago. It's super easy now. So we're
Yeah.
only 97,000 at the moment. So it's not,
Yeah.
considering all the tailwinds,
Yeah.
you kind of would be expecting uh, to be having a conversation of a pullback at a
Yeah.
lot higher level.
Yeah, no, that's awesome, and it's really cool just to see that you're incorporating that into the big to the Kiwi Saver strategy as well. Because I know that, like, a lot of people will be moving funds usually at the worst possible time to kind of chase the high performance, which is always in the past.
Yeah, yeah,
But I think, yeah, like it's just good case in point that set your strategy, try not to fiddle with it too much. And you'll get there eventually. But that's pretty cool.
yeah.
So, what else do you see kind of happening as we do finish up? What do you see happening in 2024 to 2025 to markets in general? Are you seeing that, hey, it's odds are definitely in the favor of continuation around this bullishness, and it's just going to keep on going? Obviously, we putting black swan events
Yeah,
aside,
yeah.
there's enough fundamentals to say more positive than negative, correct?
Correct.
Yeah.
Um, it was easier to make calls at the end of 21, 22, 23 as to what the year ahead looked like, because 21 was obviously crazy stuff. 22, I felt the market had sold off way too much. Things were super cheap. Like stocks like Tesla and Meta were under $100. It was kind of table thumping stuff to start buying.
Mm.
And then you could say, well, inflation was probably going to come down. 23 was sort of, well, rates are going to come down or have peaked. There's less obvious mispricings in the market than there were in the last couple of years.
Mm.
So the most logical thing is to kind of expect the current trends to continue. I don't know if you've ever heard the stat, but the most accurate way to predict the weather is to do yesterday's forecast. I think it's like 65% accuracy.
I didn't know that.
So
That's
maybe the same as for the stock market is like, yeah, it'll probably just continue
yeah.
at the moment.
Yeah.
Um,
Interesting. So it's kind of like a large language model. It's just predicting the next move, whatever that
yeah,
is, right? Like that's kind of where the
yeah,
market is at right now. Interesting.
yeah.
Okay. So
Uh,
if people want to follow you, Mike, if they want to learn more about Pi funds, where should they go?
Pyfunds.co.nz, basically. Yeah, that's where you
Amazing.
find me, or on LinkedIn.
Cool. Awesome. Well, I really appreciate your time today. I'll let you get back to doing the good work, and we'll catch up with you again maybe in 2025.
Pleasure. Thanks for having me.
Cheers, man.